Hey there, Pat Strubbe, founder and managing partner of Preservation Specialists. I wanted to shoot the video today for you because I was just thinking about 2022 has really been a wild ride in the financial world. You think about interest rates going up so much, inflation unlike anything we've seen in decades, and certainly the stock market. A lot of losses, a lot of ups and downs. Really thought it would be a great time to take a step back and look at how the stock market makes completely different experiences over different time frames. So we want to look at 3 time frames today. So the first one is short term. So we would call short term anything under 1 year. Now, in the old days, when you would look at the prices in the newspaper, that would be like on a daily basis. But of course now it's second by second or milliseconds probably, as prices are changing all the time. The phrase we call the stock market during this type of time frame, we call it a lunatic asylum. So anywhere inside a year, you can expect the stock market to behave completely irrationally, and that is in response to the fear that's going on day to day. So, for example, although the trend line return of the U.S. stock market is about 10% annually, in only 7 of the last 96 years has the return been somewhere between 8 and 12%. In all the other years, the market has been either much more optimistic or much less optimistic than the long-term returns would be normal. The biggest year up of those 96 had a return of 54%, and the worst year was a loss of 43%. Now, this is obviously irrational. A person exhibiting that type of behavior would be institutionalized because those returns don't make any sense. So when the stock market does it, the financial media loves to report about it, and of course they love to grab your attention with it because that's what sells. So that's the short term. That's anything under a year. Now we go to the second one, which is the medium term. This would be anything between that 1 year, and we're going to go out to about 10 years. So this is where the markets are more moderate, but they can still overreact significantly. You can see it edging towards any type of unique circumstance, whether it's international issues or interest rates or things like that. There's still overreactions, even in that type of time frame. One great example of that would be the global financial crisis, which we would say kind of late 2007 to early 2009. This was really the greatest panic since the Great Depression. When you look at the economy during that time, from the best to the worst, the economy got smaller by 5.1%. In response to that, the profits of the U.S. stock market declined significantly from a peak of $87 a share down to $49 in 2008, which was 44%. And during that time, the stock market went down by 57%. So this speaks to what we were talking about before, which is, generally speaking, the stock market is going to overreact. Now, why does that happen? Of course, I think there are natural reasons for it to happen. There's also the fact that the financial journalists are provoking these types of things by, selling fears and things like that. So once again, remember, even in a time up to 5 to 10 years long, the stock market can overreact. And then we come to the long term. So this would be 10 years and above. This is when the returns of the stock market are much more likely going to match the actual value of the companies that it's tracking. If we go out past 10 years, those are going to really come closer together. So the example we like to use is if we think of a retirement lasting maybe about 30 years, let's go back 30 years. In 1992, the earnings of the S&P 500 was $22, and now it's $220, whereas the index was 436, and now the index is 4,200. In both cases, it's about a 10 times return. So this is where we are right now. The markets are crazy. Could it go down a lot more? Absolutely it could. Could it bounce back tomorrow? It absolutely could. We do not have a crystal ball, sadly, but what we are here to do is help you do long-term planning and get the allocation that's right for you. So we hope that's a helpful summary of the market. If it is, if the market roller coaster is ever giving you heartburn again, we encourage you to rewatch this. We hope you have a great day, and let us know if we can be of any help.